Welcome back to Supernova. Today, we'll be discussing personal finance and investing strategies that have proven successful in real-life scenarios. We'll be looking at some case studies and examples to help you understand how to manage your money better and make informed investment decisions. There are many different investing strategies that investors can use to achieve their financial goals. Here are some of the most common ones. Number 1. Value investing. Value investing is an investment strategy that involves buying stocks or other assets that are undervalued by the market. The goal of value investing is to purchase assets at a price lower than their intrinsic value, and then hold them until the market recognizes their true worth and their price increases, generating a profit for the investor. Number 2. Growth investing. Growth investing is an investment strategy that focuses on investing in companies that are expected to experience above-average growth in earnings or revenue. The goal of growth investing is to generate capital gains by buying stocks in companies that are expected to increase their earnings and expand their businesses over time. Growth investors typically look for companies that have a history of strong earnings growth, high profit margins, and a competitive advantage in their industry. They may also look for companies that are developing innovative products or services, or that are benefiting from broader trends in the economy or society. Number 3. Income investing. Income investing is an investment strategy that focuses on generating regular income from investments. The goal of income investing is to create a steady stream of income that can be used to supplement other sources of income or to fund living expenses. Income investors typically invest in assets that generate regular income, such as bonds, dividend-paying stocks, and real estate investment trusts, REITs. These assets typically provide a fixed or variable income stream, either through interest payments or through regular dividend payments. Number 4. Index investing. Index investing is an investment strategy that involves investing in a portfolio of assets, such as stocks or bonds, that track a particular market index. The goal of index investing is to generate returns that are similar to the overall performance of the market, while minimizing the fees and expenses associated with actively managed investments. In index investing, investors purchase shares in a fund that is designed to track the performance of a particular market index, such as the S&P 500 or the Nasdaq. These funds typically hold a diversified portfolio of stocks or other assets that mimic the composition of the index they track. Number 5. Momentum investing. Momentum investing is an investment strategy that involves investing in assets that have recently experienced strong performance and are expected to continue to do so in the short term. The goal of momentum investing is to capitalize on the momentum of a stock or other asset and generate above-average returns. Momentum investors typically look for assets that have shown positive price momentum over a short period of time, such as a few months, and then invest in those assets with the expectation that they will continue to perform well in the near future. They may use technical analysis or other quantitative tools to identify assets with strong momentum. Number 6. Contrarian investing. Contrarian investing is an investment strategy that involves investing in assets that are currently out of favor with the market, with the expectation that they will eventually rebound. The goal of contrarian investing is to capitalize on market inefficiencies and generate returns by buying assets when they are undervalued and selling them when they become overvalued. Contrarian investors typically look for assets that are trading at a discount to their intrinsic value, or that have been oversold due to market fluctuations or negative news. They may also look for assets that are out of favor with investors, such as companies in a troubled industry or a market sector that is currently out of favor. Number 7. Buy and hold investing. Buy and hold investing is an investment strategy that involves buying high-quality assets, such as stocks or bonds, and holding onto them for an extended period of time, typically years or even decades. The goal of buy and hold investing is to generate long-term capital gains and income, rather than trying to make quick profits through frequent trading. The buy and hold strategy is based on the belief that the market tends to move upward over the long term, despite short-term fluctuations and market volatility. By holding onto quality assets over time, investors can ride out short-term market fluctuations and benefit from the long-term growth of the market. Ultimately, the best investing strategy will depend on an individual's financial goals, risk tolerance, and investment time horizon. It is important to do your research and carefully consider your options before choosing a strategy that is right for you. Number 1. The power of compounding refers to the ability of an asset to generate earnings that are reinvested to generate additional earnings, which in turn are reinvested to generate even more earnings. Over time, this compounding effect can lead to significant growth in the value of the asset. The concept of compounding is often associated with investing, where the returns generated from an investment are reinvested to earn even greater returns. For example, let's say you invest $1,000 in a stock that generates an average annual return of 8%. At the end of the first year, your investment would be worth $1,080. If you reinvested that $80 back into the stock, at the end of the second year, your investment would be worth $1,166.40. By continually reinvesting your earnings, your investment can grow significantly over time. The power of compounding is not limited to investing, though. It can also apply to other areas of life, such as education or career development. For example, if you learn a new skill that makes you more valuable to your employer, you may be able to earn a higher salary or be promoted to a higher paying position. The additional income you earn can then be reinvested in your education or career development, leading to even greater earnings in the future. Overall, the power of compounding highlights the importance of starting early and consistently reinvesting earnings over time. It is a powerful tool for achieving long-term growth and financial success. The power of compounding. Our first case study is about the power of compounding. Meet John, a 25-year-old who started investing $500 per month when he was 25 and continued to do so until he turned 35. John's investment earned an average return of 10% annually, and he stopped contributing after 10 years. However, the investment continued to compound at the same rate for the next 30 years. At the age of 65, John's investment had grown to $1,174,162. This is a classic example of the power of compounding. Number 2. Value investing is an investment strategy that involves identifying stocks that are undervalued or trading at a price that is lower than their intrinsic value. The goal of value investing is to buy stocks at a discount to their true value and then hold them until the market recognizes their true worth and their price increases, generating a profit for the investor. Value investors typically focus on a company's financial statements, such as its balance sheet, income statement, and cash flow statement, to determine its intrinsic value. They look for companies that have strong fundamentals, such as high earnings growth, low debt-to-equity ratios, and high return on equity. Value investors also use a variety of other tools and techniques to identify undervalued stocks, including analyzing a company's competitive advantages, management team, and industry trends. They may also look for stocks that have been oversold or have suffered a temporary setback that has caused their price to drop, but that they believe will recover in the long run. One of the most famous value investors is Warren Buffett, who has built his fortune by investing in undervalued stocks and holding them for the long term. Buffett's investment philosophy is based on the idea of buying great companies at a fair price, rather than buying cheap stocks in the hope that they will rise in value. Overall, value investing is a long-term strategy that requires patience, discipline, and a deep understanding of a company's financials and industry dynamics. While it may not generate quick returns, it can be a highly effective way to build wealth over the long term. Value investing. Our next case study is about value investing, which involves buying undervalued stocks that have the potential to grow. Meet Sarah, who invested in Apple when it was undervalued and not very popular. She held onto the stock for over a decade and sold it when Apple became a household name. Sarah's investment earned her a 1,000% return. Number 3. Diversification is an investment strategy that involves spreading your money across a variety of different asset classes, such as stocks, bonds, real estate, and commodities, in order to reduce risk and maximize returns. The goal of diversification is to create a portfolio that is less vulnerable to the fluctuations of any one particular asset class or investment. The basic principle of diversification is that by investing in a variety of different assets, the performance of any one asset is unlikely to have a significant impact on the overall performance of the portfolio. This helps to reduce the risk of losing money due to the failure of any one investment. There are several ways to diversify your portfolio. One approach is to invest in a mix of different types of assets, such as stocks, bonds, and real estate, with varying degrees of risk and return potential. Another approach is to invest in a mix of different companies within a particular asset class, such as investing in stocks across different sectors or industries. Diversification can also be achieved through geographic diversification, by investing in companies or assets from different regions or countries, or by investing in different types of currencies or commodities. While diversification can help to reduce risk, it is important to note that it does not eliminate it entirely. There is always the possibility of market-wide risks that affect all asset classes, such as economic recessions or global pandemics. However, by diversifying your portfolio, you can help to minimize your exposure to these risks and maximize your chances of achieving long-term investment success. Diversification. Our final case study is about diversification, which involves investing in a variety of assets to reduce risk. Meet Tom, who invested in a mix of stocks, bonds, and real estate. When the stock market crashed in 2008, Tom's stocks lost value, but his bond and real estate investments held steady. As a result, his overall portfolio didn't take as big a hit as it would have if he had invested only in stocks. So there you have it, 3 examples of successful personal finance and investing strategies. Compounding, value investing, and diversification are all strategies that can help you grow your wealth over time. Remember, it's important to do your research, develop a sound investment plan, and stick to it. We hope this video has been informative and helpful. Don't forget to like and subscribe to our channel for more content like this. Thanks for watching. Like, share and subscribe to our channel. We will see you on another one.